Everyone wants to find that perfect dividend stock, but here's the truth: no stock is flawless. Every company has strengths and weaknesses, but what I've found are three dividend stocks that are almost perfect. These aren't high yield plays you buy for short term income. These are world class businesses with strong dividend growth and huge balance sheets and long term upside. In this video, I'll break down these three companies and explain why I think they're perfect dividend stocks for 2025 and beyond. Stick around because the last one might surprise you. Let's start with Visa, ticker symbol V. Visa is the backbone of global payments. They don't issue credit cards, they don't loan money. What they do is act as the middleman, and every time you swipe, tap, or shop online, every single transaction that runs through the Visa network earns them a small cut. Now, from a dividend perspective, Visa looks weak at first glance because, as you can see, the dividend yield sits at 0.69%, less than 1%, which turns away a lot of dividend investors. But here's the key: you gotta believe in dividend growth. Over the past 10 years, Visa has been raising its dividend at a compound annual growth rate of 17%. That means your income doubles every few years if you hold long term within Visa. Visa also has incredible financial strength. They consistently generate high free cash flow, their profit margins are over 50%, and their balance sheet is clean. This gives them tons of room to keep rewarding shareholders not just with dividends but also with buybacks. So you're probably wondering what the catch is. Honestly, it's valuation. Visa tends to trade at a premium price to earnings multiple. Right now it's sitting at around 27 to 30% times earnings, which is higher than the market average. That means you're paying up for quality. So you're probably wondering to yourself, is Visa perfect? And the answer is no. The low yield and high valuation keep it from being flawless, but it's almost perfect from the growth potential and long-term moat in digital payments. With all that Visa talk out of the way, now let's move on to a tech giant that's as steady as they come when it comes to dividend growth. That tech stock would be Microsoft. Microsoft is one of the most dominant companies in the world. They've built a fortress of businesses that cover software, cloud computing, gaming, and now artificial intelligence. First, let's talk about the dividend. Microsoft currently yields about 0.7%, which again is low, but just like Visa, the story here is dividend growth. Microsoft has raised its dividend every year for 20 straight years, with a 10-year dividend growth rate of around 10%. That's extremely impressive for a company of this size. The real power behind Microsoft's dividend is their cash flow. They generate over 60 billion in free cash flow annually. Their payout ratio is under 30%, which means they're only paying out a fraction of what they earn to their shareholders. That leaves plenty of room for reinvestment in the business and future dividend hikes. Now let's talk about Microsoft's growth engines. Azure Cloud, their cloud segment is growing double digits and competing toe to toe with Amazon Web Services. They also have Office 365 and Windows. These are recurring revenue machines. Businesses rely on them, and that won't change anytime soon. And the last one would be AI investments. Through their partnership with OpenAI, they're embedding AI into products like Office and Azure, giving them another growth runway. So why isn't Microsoft perfect? Again, valuation. The stock trades at a premium, around 33 times earnings. That's expensive. Plus the yield is low, so if you're looking for immediate income, Microsoft won't scratch that itch. But what makes Microsoft almost perfect is the balance of safety, growth, and reliability. If I had to pick one stock to hold on to for the next 20 years, Microsoft would be at the top of this list. And the last stock on my list might surprise some people because it's not typically thought of as a dividend play, but it just became one, and that stock would be Alphabet, ticker symbol GOOGL. The parent company of Google, YouTube, and Google Cloud just started paying a dividend in 2024. That's right, after years of speculation, they finally rewarded shareholders with a payout. Now, like with the two other stocks I showed you, the yield is small, less than 1%, but here's the big deal. Alphabet has one of the strongest balance sheets in the world. They have over 100 billion in cash and marketable securities, practically no debt compared to their size, and they generate enormous amounts of free cash flow. That means that they have all the firepower to turn this small dividend into serious income stream over time. Remember, every dividend aristocrat we know today, Coca-Cola, McDonald's, Johnson & Johnson, they all started with small payouts. Alphabet could be in the early stages of becoming the next dividend growth powerhouse. Google's business is also incredibly strong. Their search is still dominant with over 90% of the market share worldwide. YouTube is one of the fastest growing ad platforms and could rival Netflix in streaming revenue long term. Google Cloud is growing rapidly, fighting for market share against Microsoft and Amazon. AI investments like Gemini and their AI search tools could reshape their ecosystem. So you're probably wondering what keeps them from being perfect, and that would be the track record. Alphabet doesn't have decades of dividend history like Visa or Microsoft. It's still new to the dividend game. That makes it a bit more riskier for income focused investors. But if you're thinking long term, Alphabet has the potential to be a future dividend growth giant. So there you have it, three dividend stocks that are almost perfect, being Visa, Microsoft, and Google. All three have global dominance, incredible cash flow, and the potential for decades of dividend growth. The common theme: the yields are low today, but the growth potential is unmatched. These are companies you buy for the next 10, 20, and even 30 years, not for short term income though, but for long term income. Now I want to hear from you. If you had to pick just one of these three for your dividend portfolio, which one would it be? Drop your answer in the comments below. And if you found value in this breakdown, hit that like button, subscribe, and turn on notifications so you don't miss future videos. Thanks for watching, and I'll see you guys in the next one. Peace.